Well, we had a couple of positive news stories today. We did have United States consumer sentiment hit 15-year highs. We also saw the successful launch of a couple of new IPOs. We also saw some conciliatory types of comments regarding trade between the United States, Canada, and Mexico, of course, as a reaction to the trade war between the United States and China. But despite all of that, we actually had a very sour end to the week. Our sentiment on Wall Street remains pretty darn bearish. In fact, for most of the indices, we've been bearish for the last couple of weeks. The Dow Jones actually briefly went to a bullish posture for one day here yesterday, but even that flipped back to a bearish posture today. So in our trade application example here today, I am going to look at the beaten down energy area to see if we can find another bearish candidate within that ugly portion of the market. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 17th, 2019. If you're new to these videos, we'd encourage you to go to YouTube, click subscribe. While you're over there, go to the description area and sign up for our email distribution list where you can receive a daily email telling you which stocks are giving you overbought and oversold cluster signals in the S&P 500. In addition to that, we're heavy users of Twitter. We always appreciate the engagement that you guys give us there, including your likes and retweets for these Market Outlook videos. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. Lastly, we do have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. For those of you that are premium market scholars that want to follow along at home with your own charting package. Now, as a reminder, this particular chart setup is going to show us 4 different charts. Each one of these charts is 3 months in length. Each one of the candles represents 1 day. And so the 4 charts in question are the S&P 500 in the upper left, which was down 0.58% today. The Dow Jones in the upper right, which was down 0.38% today. The NASDAQ Composite in the lower left, which was down just over 1% today. And then lastly, the Russell 2000, which was down 1.38% today. So as you can see from that candle right there, that was the ugliest looking candle, and it was the most significant pullback on a percentage basis as well for this smaller cap area here in the United States. Now, as I mentioned in the intro, notice up here to the right, we do have the Dow Jones Industrial Average. Notice that yesterday it briefly went to that bullish posture. Remember, we make it nice and easy for you on these different color-coded charts here, where that background color went to that light green color there for just one single day and then reverted right back to that dark pink color where we stand right now. And so that is a reminder that we had a tiny little blip higher there in the green intermediate line on the Dow Jones yesterday, but then went right back lower again here today. Whereas that hasn't been as big of an issue with the other indices, because you can see even visually with your own eyes that it's been more of a downward sloping green line there for the S&P 500. Same thing down below here with the NASDAQ Composite, and same thing down below here with the Russell 2000. So really it was only the Dow Jones that had kind of flattened out there with the green line to give us that brief moment of bullishness, but even that was very short-lived. So for the last 2 weeks that I've been doing these presentations, we have been doing bearish trades in this particular presentation. I think 3 of my bearish trades were in the healthcare area, and then the last time was in the consumer discretionary area. And I'm going to focus on the energy area for a bearish trade a little bit later today, but just a reminder that that's not exactly normal. More times than not, we're going to have more bullish conditions than bearish conditions, but this has been one of the longer pullbacks that we've seen in quite some time here, probably dating back to late 2018. So a little uncomfortable here for a lot of market participants in the month of May. Let's go ahead and also remind you that the moving average colors will tell us whether price is below a falling moving average or not. And in the case of the Russell 2000 and the Dow Jones, notice those moving average colors are red. So that is the case for those, whereas the moving average colors for the NASDAQ and the S&P 500 are yellow. Reason for that is price is below the moving average in both of those cases, but the moving average itself hasn't quite fallen yet. So it's kind of in that flattish state right now. But of course, if market conditions continue to stay bearish into next week, then of course that very well might change to a red color at that time as well. So, to nobody's surprise, market conditions remain bearish. Our postures, our intermediate term postures, according to the market forecast technical indicator that you can find on the Thinkorswim platform, are considered bearish across the board still. All right, let's go ahead and take a look at our next chart setup, which will be chart 4C. This is our 3 green arrows chart setup, or in this case, 3 red arrows chart setup, because as you can see, there is a pink shading behind the candle on all 4 of our charts right now. And this particular chart setup, which is chart 4C, will show you the same 4 indices that we looked at on the last chart setup, and it'll still look at 3 months worth of time, and each one of the candles is 1 day. But what's different is here we're not looking at the market forecast technical indicator. Here we're looking at 3 different technical indicators, including the 30-day moving average, the MACD histogram, and the stochastics. And we kind of have a way to score those out with green and red arrows, with, of course, green arrows being good and red arrows being traditionally more bearish. And so right now, that is where we find ourselves, is in the more bearish camp, where we do have price below the moving average, as an example up here on the S&P 500. We have that red arrow that's still in play on the MACD histogram, telling us that momentum is weak right now. And then we also have the stochastics with a phantom red arrow here as of today, kind of letting us know that the bears have been more in control of this market recently than the bulls, and closing markets closer to their lows of their ranges as opposed to closer to the highs of the ranges. So, again, clean sweep here, unfortunately, for the bears. This is still a little bit more of a negative market to be operating in. But of course, those of you that are a bit more active with your trading, you're just as willing to take bearish trades, and perhaps some of you are thrilled about these conditions. So it just depends upon who you are. But traditionally, most people that just have money sitting around in a 401k or something along those lines, they would prefer to see markets going higher. But it is also worth mentioning that cannot always be the case. We've been quite fortunate here in the United States for the last 10 years where that has been the case more often than not, but of course there will be moments here and there where we do experience bearishness, and this happens to be one of them. Let's go ahead and take a look now at our next chart setup, which is chart 4D. This is our 1040 crossover method chart. Remember, this chart becomes a little bit more important here on Friday. Reason for that is these are the same 4 indices that you're going to see here on chart 4D. The difference here in this case is that they'll go back 3 years in time. So each one of these charts, 3 years in length. Each one of these candles represents 1 week in length. And what we're doing here on this particular chart setup is evaluating the 10-week moving average, which will be listed there in orange, against the blue line, or the blue moving average there, which is the 40-week moving average in this case. And what we're looking for are crossovers of those moving averages themselves, and that will be easy to spot with the way that this particular chart 4D is set up, because the background color will change for us when that does occur. And so right now, as it stands here today at the end of the week, because remember, these weekly candles aren't official until Friday's close, which we're now at. But as of the end of this week officially, we still have not had any bearish crossovers yet, but we're awfully close. You can see that the Russell 2000 right here, to the naked eye, almost looks like it's that orange line is right directly on top of that blue line. Remember, down below here we have this MACD2 line set up to also help us to kind of fine-tune it a little bit more. If that black line is above this pink horizontal line here, it means that there is still separation between the orange and the blue lines up above. Another thing you can do to kind of train your eyes a little bit more easily is to right-click on that chart and then go to Maximize Sell. And then oftentimes you can see it if you blow it up into just one big screen. You can see that separation between those 2 moving averages a little bit more. But as you can see here with the Russell 2000, this will likely be the one that does give us a negative crossover first. Some of you might refer to that as a death cross. It's not going to happen this week, but if we get a couple more candles like we've seen the last couple of weeks here, these 2 big red candles like this, then there is a decent chance that let's say in the next month or so, we might actually see another negative crossover. And that would be a pretty quick reversal. Remember, we had a negative crossover on the Russell 2000 that was in effect all the way up until about the first week of April. Now, keep in mind, this was the kind of the laggard of the group. These other indices had crossed over bullishly much earlier in the year. So the Russell 2000 has kind of been the problem child all along here, and it might very well be the first one to give us a bearish longer-term posture using the 1040 crossover method here as well. When that does occur, David and I will do our best to inform you upon that. All right, let's go ahead and now take a look at our next chart setup, which will be chart 4E, and this is our intermarket analysis 12 grid. As a reminder, when we're looking at these 12 grids, the background colors of the charts will tell you whether we have a bullish posture using that intermediate line on the market forecast or a bearish posture. And if it's green, of course, that's bullish. If it's pink background color, that means that it's bearish. And so you can see it's a little bit of a mixed bag here with this first set of 12 grids, and that's by design. Remember that this first set of 12 grids is intentionally including charts that really don't have a whole lot to do with the stock market itself. We'll get into the stock 12 grids here in just a little bit. But, you know, as you can imagine, the stock 12 grids probably aren't going to look so friendly, so there may be some other interesting areas to find strength out there outside of the stock market. So a couple of those areas that we've been talking about regularly here in these presentations, not only just in the last couple of weeks, but really for quite some time, is the US dollar. I mean, that thing is just, a freight train to the upside. It's a very impressive chart there. The UUP just keeps on going higher and higher and higher. The US dollar continues to strengthen against a basket of other foreign currencies around the world. And right now, we're at, let me just check here. I think this is actually a closing 3-month high. Let me right click and maximize this as well. Yeah, we are at a closing 3-month high. It's about a tie here. In fact, let me check this metrics. Remember up here where it says H colon, where I'm kind of circling with my mouse, if I come over here to this candle, it'll show me that H colon is 26.35, and that's exactly where we closed today. So kind of interesting there, and that was the high of the day as well. So we actually touched the exact same level on these two candles, but we will give the tie to the bulls in this case, the bulls of the dollar, and the reason for that is we closed at the high on this candle. We did not close on the high on this candle, so that is slightly more bullish. And again, the path of least resistance for the US dollar continues to be to the upside. There should be no question about that. You can see that over the last 3 months, there was only one minor portion here along the way where you had that moving average yellow just briefly for 2 or 3 days. But otherwise, every other single day for the last 3 months, the moving average itself has been trending higher, and prices have been above that trending higher moving average. Those are strong indications that money is seeking safety in the U.S. dollar right now. Another place where it's looking for safety is U.S. government long bonds. Remember, interest rates themselves continue to fall. That's your chart right up here, the TNX. Interest rates were down another 0.5%. Here today. So we find ourselves ending the week on the TNX, which is the 10-year U.S. Treasury yield, at 2.39%. And remember, it wasn't too long ago we were at 3% within the last year. So we've fallen quite a long ways on 10-year interest rates. Now, of course, the inverse of that, when interest rates are falling, bond prices themselves are rising, and that is what we find right here with TLT. Now, I addressed this point last time as well when I did the video with you guys. Foreign bonds seem to be one of those places that has some strength. In fact, I think it was that candle when I pointed it out right there, because this week was a little different. David and I have had to flip around our schedules a little bit because of a few things that he's got going on, but it would have been right here on this candle. It would have been Tuesday. Where I mentioned BNDX looked prime for a breakout and was one of the only truly bullish trending charts that were out there. And of course, we have had a continuation of that move. 3 more straight days to the upside for BNDX. So keep your eye on that. As I said on Tuesday, it's not the most fun or exciting place to be hanging out with your money, but nonetheless, it is working right now. So foreign bonds, U.S. government long bonds, U.S. dollar, those are areas that seem to be working better than others right now. Places where it's a little bit more skittish, gold is a bit disappointing. Boy, I keep thinking, with all this controversy around the world with geopolitical concerns and everything, that maybe people will be seeking the safety of gold. We also heard today that Bitcoin kind of imploded, and sometimes people will kind of drift their money from cryptocurrencies over to something like gold. But that's just simply not happening right now. Gold cannot find a whole lot of buyers out there, and that is an ugly looking chart. /GC, an ounce of gold is now going for about $1,277. and it continues to have a bearish posture right there. Now, of course, big portion of that downward move is what I've discussed already with the US dollar. Remember, all else being equal, when US dollar prices are rising, there will likely be weakness within gold and other types of securities that are priced in US dollars. And so keep that in the back of your mind. We did find that the VIX did go up today, but not a whole lot. It was only up 4%. Remember, earlier in the week, we were actually above 20 on the VIX. I know this doesn't show it here. It does show it up at the top. It's at 16 right now. Earlier in the week, we were above 20. This is a percentage scale that we're looking at here. But anyway, it has come down pretty dramatically here in the last 4 days or so. And so I thought with today being a little bit more of an aggressive down day, remember the Russell 2000 actually had a really ugly day, down 1.38% today on the Russell 2000 or whatever it was. That's a pretty aggressive day for an entire index. And so I figured the VIX would have caught much more of a bid higher based off of that movement. So while it was up, like you would expect, it just wasn't a dramatic move out of the VIX. And it does find itself basically at its lowest closing price of the week. And actually on an intraday basis, it did touch its intraday low for this week as well, after attempting that big breakout here a couple of weeks ago. All right, let's go ahead and take a look at our next chart setup. This one's going to be chart 4F, and this will be our 12 grid that focuses on foreign stock markets. Now, as you can see here, there's only two green charts on the board, and that's Russia and the aforementioned Canada. Remember, Canada was in the news here today in the talks of dealing with the United States and Mexico, etc. Maybe hoping to open up the borders a bit more here in terms of trade, if we're not going to have as rosy of relationship with China going forward. So Canada holding up reasonably well, and I would even say its neighbor over here, if you take a look to the left, Mexico. The neighbor on the chart, of course, not the neighbor in reality. But nonetheless, our friends here in North America. Mexico actually doesn't look terrible either. It does have a bearish posture. It does have that pink background color there. But it has held the line nicely in the last couple of weeks. If you're looking at Brazil as an example, look at all those candles just going straight down for the last couple of weeks. Pretty much the same thing with China over here. And there's a handful of them. You can see South Africa going straight to the downside. So while this shouldn't be viewed as, robustly bullish and, drop everything now and buy a bunch of shares in Mexican ETF, the fact that they held the line is showing relative strength. And so we're going to keep our eye on that. Perhaps money is going to start rotating from some of those Asian economies into North American ones with Mexico and Canada at the forefront there. So let's keep our eye on that story going forward. All right, let's go ahead and take a look at our next chart setup now. And this one will be for G. And this is going to be the U.S. sectors 12 grid. And as we can see here, it's mostly pink. It's actually the exact same pink versus green ratio that we had when I did this video on Tuesday, which is the three on the bottom are the three only bullish ones here, and that's your consumer staples, your utilities, and your real estate. In fact, we were kind of having this conversation in Strategy Lab on Wednesday. For those of you that are premium members of Strategy Lab, remember you can access those materials oftentimes on our blog. In fact, let me pull that up here real quick. Here it is. And we were having that conversation where dividend yield strategies or factors really weren't doing all that well in 2019 up until the last week or so. And then we started to see a bit more of that. So as a reminder to those of you that are premium members of Market Scholars, you can now use this table I have down below for Strategy Lab and sort and filter on your own if you desire. It does sort by year-to-date performance automatically, but if you wanted to come over here and, for example, sort it by 1 week performance, you could do that. And you'll notice here all of these purple colors showing their way up to the top, and that purple color is the low volatility factor, but you also see a lot of these green colors up here in the top 10 as well, and that's your dividend yield. So if you think about those two concepts, low volatility and dividend yield, and then ask yourself when you come back on over here to this 12 grid of the different sectors, which sectors fit the profile of low volatility and high dividend yield, then your mind should immediately drift down here to the consumer staples like your Coca-Colas and your Kimberly-Clarks and Procter & Gamble's, or your utilities like your Consolidated Edisons and your, NextEra Energies and those types of companies. And your real estate companies like Simon Property or American Tower and those types of companies that pay you those bigger dividend yields and offer you that lower volatility. So we are seeing that vibe coming through the markets. So for those of you that are attempting to take more bullish trades in this market despite its overall bearishness, then the areas that seem to be working from a bullish perspective are those more mundane, boring areas of the market like the staples, utilities, and real estate. But otherwise, it looks pretty ugly out there with most of the other cyclical areas of the market. Also, while I was over here, I should have mentioned that I appreciate those of you that click the like button on Twitter whenever you see our market outlook videos. So thank you to the 90 of you that did that last time. Generally, I'd like to see that number get up to 100 to make it feel like it was worth my while to take the 2 hours to produce the video. So we always want to make sure that you guys get value out of your time here with us. And so we want to continue to do these on a daily basis, but we also need you guys to support us along the way. And the easiest way for you to support us, it only takes 5 seconds and it doesn't cost you any money. All you have to do is click the word like if you're so kind. You don't have to, obviously. Some of you will refuse to do that, but those of you that have the ability and the desire to support us, we would certainly appreciate that. So thank you to those of you that did that last time, and I hope you can do that again for us here tonight on the video. All right, back on track here. I did want to quickly address that the energy sector did have a bit of a bounce down here today. So this is XLE. Let me just kind of right click, maximize this so you guys can see this a little bit better. So notice that the background color of the chart is pink, telling us that we do have a bearish posture according to the market forecast because that green line is in the lower reversal zone here. But notice that we had a pretty strong pullback here today in energy. In fact, this was down over 1% here today. This is XLE, so this is think about all of the companies that are digging for oil out there or servicing that or potentially transporting that. So those types of companies. And so we had kind of a bounce down type of a candle here today. In fact, notice these long upper shadows on these candles as well, telling us that there were more bears on an intraday basis when that occurs, because we did close the session in the lower half of the range when you see that type of behavior. It's kind of the opposite mindset of when you see those those long lower shadows there, which are traditionally kind of known as more bullish. These ones would be considered a little bit more bearish. And you can also kind of make the claim here with today's move down that we had a close below the low of the high day. Some of you remember that kind of swing trading mentality that you might have been taught in the past. And so we did officially have that. And of course, we do have a downtrending moving average with price below that moving average. So the moving average itself is red. So I wanted to concentrate on this particular sector for our trade application here today. And the energy sector has been one that's been near the bottom of the sector selector tool here in most recent months as well. And of course, I normally don't do this video on Fridays. David usually does. So the sector selector production will be delayed just a bit this week as I kind of have to reprioritize things. But later on tonight, I'll produce that sector selector to see what the new rankings suggest. But I would guess that energy would still be closer to the bottom than the top. But stay tuned to that. I'll post that on Twitter over the weekend as well for those of you that want to see those sector selector rankings. But for the trade idea, what I'm going to do is I'm going to come on over here to chart 4A, and we're going to pop in one of the most popular stocks in the energy patch. In fact, I believe it is the second largest component of XLE. And remember, XLE is one of the most heavily concentrated sector ETFs out there. Exxon and Chevron make up a huge portion of that particular ETF compared to the concentration levels of individual stocks within other sector ETFs that are out there. So XLE is a bit more unique, where there's not a whole lot of components to it, and those at the top like Exxon and Chevron do make up a massive portion of that. So So in other words, if you expect XLE to have bearish conditions going forward, then you're effectively saying that you probably expect Chevron and Exxon to do likewise. So let's talk about Chevron here, and I'll kind of explain what I'm looking at from a bearish perspective here. First of all, note that we had a bit of a change of posture here recently. Notice how we went from this bullish green color on the chart to this dark pink or reddish color on the background of the chart. And that signifies the fact that we now have a bearish posture from an intermediate perspective according to the market forecast technical indicator. Remember, we know that because down below when you're looking at that green line on the market forecast, it was going up during this time period. So during these candles, it would have been considered bullish. But when it failed to continue to go higher and now has rolled over for the last couple of days, that green line has now rolled over as well. And we are now getting those more bearish indications there. Now, in addition to the bearish intermediate posture, notice that the market sentiment line, which is even longer term than the intermediate line, is at 56 and falling. And you can kind of see that dotted orange line on our chart right here. And that is also considered bearish. Remember, when it is falling between 80 and 20, like it is right now, we would consider that to be bearish from the longer term perspective. So not only just the intermediate perspective, but also the longer term perspective. Now, in addition to those things, let's look at the blue line. The blue line also gives us some interesting information to consider because this blue line you will recognize has a couple of peaks here recently. We have peak number 1 and peak number 2. Well, you'll notice clearly peak number 2 is well below the levels of peak number 1. And so theoretically you have what's known as lower highs on the near term line. Well, look at what that corresponds to up above, which is this candle and this candle. Now notice this candle is slightly higher than this candle. So in other words, price is showing us higher highs. The indicator is showing us lower highs. And so that would be known as a bearish near-term divergence that's taking place here as well. So a lot of different things going on. In addition to that, I would say that there's probably some pretty strong resistance in this area right up here at around, let's call it 122 or thereabouts. Notice that we had a lot of struggle to get past 122 for these 5 candles in a row right here. We also struggle with that level here and here and here and here. So it does seem like there's sellers just setting up shop right around those levels. And interestingly enough, for those of you that understand that concept in technical analysis, that old support can become new resistance. Notice that this candle right here, its low price was 122.02. So in other words, basically $122 even is exactly where that thing found support. And now that it gapped lower after this time period here in April, it is now using that area as resistance at this point. So those are some of the reasons why this one could make for a somewhat interesting bearish type of a trade setup. Now, some of you might choose to initiate bearish trades by just simply shorting the stock. Remember, if you are shorting the stock, you have to have a margin account because you can't do it in an IRA account. You have to have approval through your broker to do it. You do have the risk of having to pay out the dividend when you are the one shorting the stock. And remember, Chevron is a dividend aristocrat company, so that might enter into the equation. And theoretically, you're taking on unlimited risk to the upside when you are shorting a stock because there is no ceiling to the stock market the way that there is a floor at 0. So while we don't expect Chevron to quadruple or anything anytime soon, you just never know. So those are some of the things you have to think about when you're shorting stocks. On the other hand, you can do bearish trades to the options world where you can define your risk a little bit more than unlimited upside risk like you would when you're shorting a stock. So one of the things that we like to implement on occasion in these classes or this presentation are vertical spreads. And what I thought we would do here today is what's known as a long put vertical spread. It's also known as a debit spread. So in order to initiate that, typically what we do is we come over here to the trade tab, and you can see I've got the trade loaded up down below here already. But what I chose for my monthly strikes is first of all, the June monthly contracts with 35 days left until expiration. And then typically what we do is we buy one strike strike that's in the money and we sell one strike that's out of the money. Well, you have to ask yourself, where are we right now? Well, we're close to $120 right now, to $120.52. And so the at the money strike would be the 120. So if I wanted to buy the first one kind of in the money, that would be the 125, and sell one that's out of the money, that would be the 115. So it is a $10 wide long put spread here. I do have to pay $4.22 out of my pocket for that. But I do also have the potential to make more than 100% return on this risk if things go really well for the trade. Now, in order for this trade to really work, what you're hoping for is for the stock to go down to the sold put, in this case 115. That's where you're maxing out your trade's potential. So again, we come over here to the chart. 115 would be down in this general vicinity. So if you think that Chevron's about ready to make this big spillover, then that could be an acceptable trade where you could double your money. Now, of course, the downside of that, when you have big upside potential like a doubling possibility, is that your probabilities of success aren't great. Remember, you could also do a bear call spread, which is a credit spread. And I actually did look at that for this one. However, because there's $5 between the strikes, coming over here and trying to sell a call spread on this one just wouldn't have done us many favors, because even selling the 125 call would have only netted us about 75 cents there. So we just wouldn't have been able to get that done for a 30% return on risk like we traditionally would want to. So I was kind of stuck or relegated to doing the long put spread if I wanted to take an options trade on this particular underlying security. But it does open up that upside potential as well. I would have only been able to make 30% types of gains over here. Here I can make over 100% gain, because this $4.22 could be worth $10 by the time it's all said and done. On the other hand, it does need directionality. In other words, you can't just have this stock go simply sideways, otherwise you're likely not going to win this trade. We do have a little bit of a head start here on this one, and what I mean by that is, if you took $125, which is the bought put strike in this vertical spread, and then subtracted out the debit that we would pay out of our pocket, which is $4.22, then our break even is at 120.78. So anything below 120.78 would land us in our profit zone for this trade. So this stock is actually at 120.52 right now. So technically, we got about a 25-cent head start there or thereabouts. And so we'll take what we can get. So let's go ahead and place that trade, confirm and send. You can see it's going to cost me $422 to do this on a one contract basis here. And we do have the upside potential of more than doubling our money. So we're risking 422, but we have the possibility of making more than 422, in this case, $578. And of course, this is Friday after the stock market closed, so we have no idea what's going to happen over the weekend, let alone on Monday morning when this opens up. But we'll put it in there for practice purposes nonetheless here in Paper Money. So I'll go ahead and send that one in, and we'll see if we can get filled. All right, well, thank you for joining me here tonight. I'll actually be with you early next week as well, as David's got a few other things going on, so I'll look forward to that. But I hope you guys have an enjoyable weekend. Remember, as a recap, we had some progress in terms of trade here today, but it was with Mexico and Canada. It wasn't with China, so markets didn't really reward that quite as much as you might have expected. So right now we stay bearish with our postures across the board, and we're looking at more of those bearish trades to kind of satisfy the active trading portion of our account right now. So with that, I want to wish you all the best of success with your trades and your investments. If you got value out of tonight's video, please go over to Twitter, click like and retweet. We do appreciate you so much. Have a great weekend. Bye-bye.